Okay, let's dive right into the Thackray's 2025 newsletter. Starting off, we focus on China because that really is the focus as far as Trump's tariffs goes. Yes, Trump is trying to get tariffs on other countries as well, but he's really after China. That's why they have such high tariffs against China. The problem is that in the Chinese culture, they have to save face in negotiations. That's extremely important to them, and they're boxed into a corner. So this is going to be a difficult one to resolve. Everybody seems to think that somehow they're going to resolve the situation with the U.S. I'm not so sure about this one because of the culture and having to save face. We'll have to see what happens. I've done several videos on the tariff situation here and talking about what happened on Liberation Day, and then after that I've done subsequent videos as well. But I do focus on an example of South Korea. Trump was saying that South Korea has 50% tariffs on the U.S. Well, that's not true in the sense that as far as tariffs go, because they have a free trade agreement. 99.7% of the goods coming into South Korea are tariff-free. Now, there could be other trade barriers as well. For instance, holding things for inspection or extra quotas or something like that. But I'm not sure that they would add up to 50%. How Trump did come up with that number, though, 50%, is he took a look at the trade deficit balance between two countries and said, well, because South Korea exports so much more to the U.S., therefore, that's because of tariffs and trade barriers. That doesn't really work out as far as if you have multiple countries trading, because you may have South Korea have different tastes than what the U.S. is actually producing. So South Korea may actually prefer to buy some of the product locally. And in some cases, some countries can't afford to buy product coming from the U.S. either. So it doesn't quite work out that way on a country-by-country basis. But nevertheless, this was the opening blueprint for the situation. The problem I have with China here, at least the situation with China and the tariffs, are that tariffs lead to trade wars and currency wars, which sometimes lead to kinetic wars, and that is not a good thing. So we're starting to see the ramp up of more rhetoric around Taiwan, which is not a good thing, and I'm really hoping that this does not spill into a hot war or kinetic war. After Liberation Day, the next week on Wednesday, April the 9th, we saw Trump come out and pause the tariffs for most countries around the world for 90 days, and with some exceptions as far as the tariffs on different sectors. So we saw the stock market, the S&P 500, put in a 9.5% rally. Now, I got to tell you that Scott Bessent, who I respect strongly as far as some of the analysis that he's had so far, came out and said this was always planned this way. And I'm going, I'm not so sure about that. But then Trump also did say that why he did it was people were getting yippy and afraid. Ultimately, what really happened was that the bond market broke Trump. The bond market forced Trump's hand, basically. And if we take a look at what happened here, this is an interesting graph because this line here is Liberation Day, this vertical line right here. And we can see here, shortly after that in red here, that's the U.S. bonds. This isn't yields, this is the bonds. Bonds went up, so yields went down. Right after that, the U.S. dollar went slightly down. Look at the S&P 500. It went down a lot. But look what happened here. We saw this peak happen for Treasury yields and for Treasury bonds, I should say. And then yields started to increase. And then see this line going down here, that bonds started to fall. So yields going up is a very problematic situation for the White House. This is not normal, by the way. In a risk-off environment, usually when the S&P 500 is falling like this, you don't see yields going up and bonds going down because investors tend to rotate into bonds. And this happened during the week. It was really pushing the market, really stressing the market out. And it was a persistent trend as well. And so the difficulty with this is Trump wants a lower U.S. dollar. He says he doesn't, but in all likelihood he does. But the one thing he can't have is he can't have higher yields because we have a lot of U.S. debt maturing very shortly, and it's extremely expensive to write out at higher yields coming up. So he needs to have lower yields. He needed to step in and do something at this point. So everything is on pause. I think what the administration is trying to do is really end up with tariffs on most countries around the world, or if not all countries around the world to some degree or other. But they're trying to manage that process. So sometimes they go too far, so they have to bring it back a little bit. And then they try again, then they have to bring it back. So we're seeing this back and forth. It's confusing and a little bit alienating as well. But I think this is what they're trying to do. So I still think the tariffs are still going to happen. There's still going to be some tariffs down the road, but 90 days is a long pause here. So they've really pushed things way out into the future. The market's starting to respond positively to that. We'll have to see what happens as far as if it's able to maintain that momentum. So tariffs are taken off the burner for now for most countries. I talk about why the yields went up. We see a lot of foreign ownership in U.S. assets, including stocks and bonds, and there's been a really anti-American feeling around the world. So we're seeing, in this case, some pension funds withdraw money from the U.S. We're seeing investors around the world also starting to withdraw some money from the U.S. And this blue line here, this blue shaded spot here, sorry, not that one. This one here, that represents foreign investments, up to 18% as far as stocks go. 18% of the market. That's huge. That's above average over the last quite a few decades. So we could see that actually pull down. So that if foreigners are selling U.S. stocks, that'll put pressure on the equity market to go down. And on top of that, the U.S. dollar will likely head lower as well. I'll get into that in just a second. If we take a look here, another reason why we've seen this happening is we've seen the breaking of the basis trade, which is really just a hedge fund trade. I described this in the newsletter here and talk about how hedge funds are long the cash bonds and short the future synthetic bonds. And they leverage up to capture that leverage on the few basis points that they can make from that trade. But that, as credit's pulling back, the repo, there's no money really left in the repo for them to do this as well. The trade's being unwound, which means there's a forced selling of treasuries. That's happening. Also, as well, we're seeing the yen carry trade reversing. So that's when institutions go and borrow money in yen, flip it into USD, and then buy US leverage up, buy bonds or treasuries, and it works fine. It has been working for decades as long as the yen's low relative to the US dollar, and there's not too much of a cost of carry as far from the Japanese side. Well, what have we seen? We've seen Japanese yields heading up as inflation's perking up there, which makes it more expensive to do the trade, and we're seeing the yen head up relative to the US dollar. So that trade's unwinding again. We saw this I think it was last August in 2024, but there's still a lot left to go in this trade, I believe, and we're starting to see some of that money being pulled out. So we're seeing this confluence of a whole bunch of different factors that really weighed on the bond market. That's been key recently. That's really been driving a lot of what's taking place. And here in this page, I talk about, well, let's take a look here. Here's the U.S. Treasury. There's it going up. That's the green line. The gold line is gold, okay? So I just threw that in there. Gold's actually been going up. I'll talk about that in a second. And the white line is the Dixie. So we can see here that the U.S. dollar has actually been going down here. And in this whole kerfuffle, it also went down. And so once again, if we take a look here, here's foreigners selling U.S. equities, which is driving this. It's a bigger force than what's being talked about out there. You know, we've seen a lot of the talk about the basis trade in the news, et cetera, but I really believe this is has a bigger impact. If we take a look, let's go back and take a look at the tech wreck that happened in the late 1990s into 2000s. I'm not saying the same thing's going to happen again here, but it's the same type of phenomenon take place. Now, these companies today in the technology sector, Microsoft, et cetera, they actually make money, which is great. And in the late 1990s, there were a lot of companies that weren't. But if we take a look here, and the situation with the Dixie, okay, so this is the currency, that's the US dollar, from 1999 to 2023, okay, so here we go. We can see here it went up. In this case here, so this is in the orange here, this is from 1999. It actually peaked in this case around just in 2000 and then went down for the next few years. Currently what we're seeing it go up here in 2024, okay, and into the beginning of the year in 2025 we've seen it heading lower. The reason I put this graph on is because what we saw was this exactly the same phenomenon taking place in the 1990s. We saw investors really jumping into technology stocks. And so to do that, when foreigners are doing that, they have to buy US dollars. And then they buy the US stocks. And once they buy the US stocks, they're holding them. But it works the other way around, which drives up the price of US dollar. But it works the other way around when they start selling the technology stocks, as they did back in the early 2000s. They sell the U.S. technology stocks, get the USD, and flip it back to their own domestic currency. The U.S. dollar heads lower. So if we follow the same pattern, we could have a multi-year situation with the U.S. dollar heading lower. Now, Trump's not against this, actually. It's just the yield he's really worried about. But it's just something to watch out for. This analog doesn't mean it's going to happen, but it does show you some of the pressure that can take place as far as U.S. dollar goes. I talk about gold. Gold here in the gold bar here, you can see these two boxes here. One's a green dotted box, and the green dotted box, that's when we saw the S&P 500 after Liberation Day start to head lower. Initially, gold headed lower, which is interesting. Which, when you have those events, sell everything, sell anything you can really. Gold went down, but the S&P 500 continued to have some struggle. And if we take a look at the yield here in blue, the yield started to increase, which means that should mean gold should go down. In tough times, yield's increasing, gold typically goes down. It actually went up and set an all-time high. And that's because there's a whole lot of monetary uncertainty going on right now. And investors were saying, well, do I want to be in the US dollar? Yes, we can go to the euro. It's going up, but you know what? Those economies are not strong. Well, maybe I'll just go to to gold. So that helped gold to set an all-time high last week. And I take a look at what else is driving the gold price. The Chinese central banks are buying gold for the 5th month as prices rally. It's possible that China is actually selling some of the treasuries as retaliation against the U.S. and switching them into gold as well, the proceeds. If we take a look, you want to also follow the MOVE index. The MOVE index is the volatility index for bonds. So we know the VIX. Most people know the VIX, which is the volatility index for stocks. So the VIX here is the yellow line, and the white line is the MOVE index. They tend to follow each other when we see a risky environment. They both tend to rise. What we saw was we did see here both of them rise into Liberation Day here and follow that up higher. Yeah. And then we saw the VIX head lower. Now this graph, to be honest, is a bit dated at this point here. We did see the VIX head lower. The move was still higher. When that happens, you want to watch that gap and see what the move index does. Does it stay high, which would indicate that we could see some further trouble, or does it move lower? It's now since then moved a little bit lower. Okay, let's take a look at some of the seasonal opportunities. Gold. Okay, let's take a look at some of the seasonal opportunities. Energy here. Energy has a strong seasonal period into early May, so just under a month from now. We've seen energy using the XLE in the States really in this trading range, go up and down, up and down, up and down. It's right here, right now. So it's come back into that box. We could see it start to move higher here if it did get oversold, and it has been underperforming under this scenario. We saw the energy sector underperform. But if we go back to a risk-on environment, usually sectors that have underperformed in the risk-off environment tend to bounce back harder. Now, that doesn't work for every sector. We can see some shifting happen here, of course, but given that we're just a little bit above this trading range here, we could actually see it bump up a little bit higher. But watch out, May 9th comes fast. Here's the industrial sector, finishes the seasonal period on May 5th. The overall trend has been down, like so many other sectors in the market. Relative to the S&P 500, it really just has been flat over the last little while. It has bounced back up here a little bit. It could reach back up to this line. That's where we might see some resistance for the industrial sector. Watch out, because it really is cyclical. We could see some of the cyclical sectors turn lower relative to the market if we start to see the whole growth scenario being questioned. Now, if we see a risk-on environment, these sectors will probably come back and slightly outperform the S&P 500 unless the technology sector leads the way. Here's the material sector, has the same seasonal period as industrials, often trades like the industrials. It has been performing better than the industrials. Now, that's partly because there's gold bullion here, a little bit of gold bullion in the material sector. This is in the U.S., so it's very different compared to Canada. But once again, we've seen this downward trend, and it's actually, at the time of taking this clip here, is actually still below that point here. But the overall scenario is it has been performing better than the industrial sector, so we could see some stronger performance, at least heading into early May here. The metals and mining sector has actually done relative to the S&P 500 in 2025, has actually been flat. Now, S&P 500 has not been the best market, mind you. And we did see this real pattern here of almost like a head and shoulders type pattern, and then we saw that break take place right here. So we have seen a downward trend and then more of a consolidation taking place recently. It could consolidate a little bit further, but if we take a look here, the seasonal period does end May 5th. Very often the materials, the metals and mining sector will end its seasonal period a little bit early as well. So watch out for this sector here starting to underperform. That would actually be an indication that some of the other cyclical sectors could be starting to fade as well. The consumer discretionary sector actually finishes a strong seasonal period in mid-April, so that's where we're at right now. That sector really did well, believe it or not, in November and December, and really poorly in January, February, March. And look at this, underperformed here. Bounced back here a little bit. This is really, this is a discretionary sector, and we're seeing some real weakness as far as some of the retail numbers coming out. So given that we're at the end of the seasonal period, it's been underperforming, this sector is probably one to shy away from. Here's the U.S. financials. Look at this. This is a left shoulder, head, right shoulder. Very definitive there. We saw that break take place. On a positive note, so that's a negative formation. On a positive note, still an upward trend relative to the S&P 500. Now, the big money center banks started to release their earnings last Friday. And then what we saw on the 11th was the financial sector as a group underperformed the S&P 500 slightly, not by a large amount. Investors really didn't like a lot of what they heard. Now, JP Morgan came out with strong earnings at the time, which helped the sector overall. So we'll have to see what happens with the following companies at the beginning of next week, or on Monday, Tuesday, we see a few more companies starting to report. So we'll have to see what happens as far as that goes. But right now, on an absolute basis, this is not a good picture. Relative basis, this is a good picture. So we'll have to see what takes place. But the sector does finish its seasonal period in mid-April here. So if we do see a little bit of a burst higher for the financial sector, it could be the last little burst before it starts to underperform. Canadian banks usually have the seasonal period up until mid-April. I've included this graph on my website. If I start to add these graphs on my website, if you look at the last tab called graphs, it's just some basic numbers and some charts for seasonality of different sectors. I've included one for the Canadian banks. I want to point out here that May and June tend not to be good months for the Canadian banking sector. And May, 38% of the time, is all that it outperforms the TSX Composite Index here. If we take a look on average, it has been negative in May and also June. So these are months where you have to be a little bit careful for the sector. Now, the Canadian banks, everybody loves them. I get all that. They're an oligopoly, blah, 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 and they pay high dividends. When the market turns down initially, they can provide some relief because of the high dividends. The big concern with the Canadian banks is if we start to see some concerns about the Canadian economy, whether it's through tariffs or real estate or whatever it is that's happening, that will come back and be reflected through the Canadian banks when that concern really starts to build. And we have to watch out for that coming up shortly. The Canadian banks do release earnings late in May, so we'll have to see what happens at that point. But remember, May and June tend not to be strong months on a seasonal basis. Let's take a look at emerging markets. Emerging markets have a seasonal period up until mid-April. That's where we're at now. Absolutely, we did see that actually break down and come back up into that above that resistance point. But look here, we saw outperformance of the S&P 500 at the beginning of the year. So that's a lot to do with the falling U.S. dollar. So we've seen the European stock markets increase, Japan, China, emerging markets. So it's really been the U.S. with the technology sector that's really lagged here. But we have seen this underperformance when we moved into that risk-off scenario with the whole tariff situation. Given that we're at the end of that strong seasonal period, we could actually start to see the sector fade very quickly. Here's the Canadian dollar. The Canadian dollar has a strong seasonal period from mid-March to the end of April. So we're in that now. April is the strongest month of the year for the Canadian dollar. Now, the Canadian dollar was consolidating for quite a while here in this box relative to the US dollar, and it's gone rip-roaring above. Now, it's not because the Canadian economy is stronger or Canada. This is the US dollar falling relative to all world currency. So it's nothing special about Canada. This is about the US. And so we've seen this Canadian dollar move higher here and strongly up to over 72 cents versus the US dollar. Now, it should be noted that the U.S. dollar starts to improve in strength in early May. So that's coming up very shortly. Typically, in the first or second week of May, we start to see some improvement of the U.S. dollar relative to the Canadian dollar. So far, we're in the strong seasonal period for the Canadian dollar, and it's working out well. Here's the utility sector in the States using XLU. The utility sector has been outperforming. Now, the utility sector can outperform at this time of the year into May as investors become more conservative, and that's exactly what's happened. We've seen investors say, well, I still want to be invested, but I don't want to be in the growth sectors of the market. So we've actually seen them move into utilities and the utility sector outperform. Here we've really seen this consolidation pattern. It's still back in that trend. We'll probably see the utility sector moderately outperform the S&P 500 over the next couple of months here as we progress here. As there's still some concerns, we may see this a strong rally initially as the tariff situation looks like it might be resolved temporarily. But in this times of uncertainty, we can still see the utility sector actually outperform. If we look at consumer staples here, they have a strong seasonal period like the utilities into May. The consumer staple sector has been trading in this tight range, and like utility sector has been outperforming the S&P 500. The sector is expensive if you look at some of the fundamentals, but investors are still paying up for that protection. So yes, if we move to a full risk-on mode and that have an extended rally in the technology stocks really start to outperform the market, you'd expect the consumer staples to significantly lag in that type of scenario. But in an uncertain market, we can perhaps see the consumer staples actually still continue to perform well over the next month or so. Okay, getting to the rants. I rant about British Columbia. I love British Columbia. It's a fantastic province. I love going there. But really, they've got their fourth credit downgrade in 4 years. Like, how? I don't follow the British Columbia politics, but how does British Columbia keep electing a government that is a financial mess, basically? We're in a fairly good time right now. And kind of wait until we go into a recession. What happens then? Like, this is kind of crazy. Anyhow, this is nothing to do with Trump. This is a homegrown problem in British Columbia. I had to laugh. If we saw the Bank of Canada here, they did come out on March 13th with a rate cut. And it really was a dovish cut. They didn't have to do that cut. And they basically say at the time, well, the tariffs are going to be having an impact. And they haven't had an impact. But they said, well, just in case. But here's the kicker on this, is a couple of days later, they came out with a report that said, well, actually, we're no longer going to guess about the future of tariff impact. We're going to wait for the data to come in. I'm going, what? What happened? You just guessed. And now a couple of days later, you come out and say, well, we're not going to do that. So you probably shouldn't have done it in the first place. Be more data dependent. I don't know. I couldn't follow that one. It was really, and the dates were really close. And then we saw the OECD come out and say that Canada might have to increase its bank rate by 1.25% because of the tariffs. Okay. We had Tiff Macklem talking about having to reduce the rate because of tariffs, and the OECD coming out and saying you might have to raise the rates because of tariffs. Now, the reason was because OECD believed it would be inflationary and raise prices, so they may have to raise the rate. But talking about crazy statements from the Bank of Canada, back to back, and then the OECD coming out. Okay, somebody's wrong big time here. Okay, I saw this here. Larry Fink vows to unlock private equity for masses. Okay, you've got a right to be suspicious on this one. I'm not accusing BlackRock of anything here, but when the Wall Street firms come out and start to recommend a new part of the market for their clients, or the mass market, I should say, you have to be a little bit suspicious. In the past, what we've seen is some of the firms have been accused of saying, well, our top tier clients have these type of investments. Now we're going to take it to the mass market. So are they trying to take their investments from their top tier clients and then give them over to the mass market because the trade is finishing up? That has happened in the past. I have no idea if that's happening now at all, but when I saw that title, I had to chuckle as well, for sure. Now, private equity, the problem with private equity is, and I'm not saying it shouldn't be part of people's portfolio, I'm not giving advice or whatever, but private equity is not mark to market. So it's based upon estimates and guesses about the valuations of the underlying assets. So you really don't know until the valuations, until things have to be sold, and then we can start to run into problems. So if there's one sector of the market that needs more liquidity, that it would be this one, at least if you're trying to move assets from some clients to another, that could be the case. Of course, Larry Fink just could be doing his job and trying to bring in more product to the market so BlackRock can make more money. That's capitalism, so that's totally possible. But anyway, I just got to chuckle out of that one. And here's another one that I chuckled over with. JP Morgan changes its mind in a record 73 minutes, and you thought you were indecisive. We're all not Warren Buffett and hold securities for decades. Now, I got to tell you, Warren Buffett, yes, he's held some securities for decades, but he does market time. It doesn't say that. He has made some short-term decisions in the past, but that's neither here nor there. But sometimes we accuse ourselves of being perhaps a little bit fake along the way. Well, look at JP Morgan. Last week they came out with an announcement saying that a recession was on the way. 73 minutes later, they withdrew that and said there's no recession coming. Now, I got to tell you that this was based upon the tariffs being paused here, but nevertheless, it is funny to see a report back-to-back, two reports back-to-back in 73 minutes with a total change of mind. Well, thank you very much for joining me today.